Hello, everyone. Welcome back to another episode. I'm your host and millennial investor, and today we're going to be going over bonds and should you be buying them now in 2020? We've had a huge drop in interest rates, and is it the time, now that the stock market is going back to all-time highs, is now the time to be fleeing to cash? Is now the time to be fleeing to bonds? Should you be selling out of your equities and be going strictly into long-term treasuries or corporate bonds that are very safe investment grade risk? We'll be going over all of that in this video with these main categories, and I'll be going over each of these, why bonds, in my opinion, are probably not the best investment right now, but I'll be giving both sides of this. Now, in this video, I will be going over not only bonds, but I'll also be going over the federal funds rates and interest rates in general, not only how they work with bonds, but where I think they're going in the future. I'll be going over the deal with AT&T trying to sell its DirecTV sector. I am a shareholder in DirecTV. It is a very small holding in my portfolio, which I'll be going over in just a minute, but I am a shareholder and it's something that I think is a positive thing for shareholders, and I'll be going over that as well. Johnson & Johnson adds $7.5 billion worth of debt to the balance sheet. And why I think this is absolutely incredible is how cheap this investment grade company is able to raise capital for almost pennies on the dollar. So I'll be going over why this is another great thing for Johnson & Johnson. And as a shareholder, once again, of Johnson & Johnson, I think this is an incredible piece of information. And then last but not least, we go over the local hero who doesn't invest so that the market can go up for everyone else. What a total beast that he doesn't invest so the rest of us can enjoy these gains in the market. And I'll be going over how this guy is an absolute hero for the rest of us. So overall, guys, if you're not used to me, if you want to support me and my channel, you can follow along with me on my journey as I track my annual dividend income, my monthly dividend income, my portfolio value, and my YouTube income, which is something that hardly any other YouTuber discloses. I did just update these numbers in the previous video, so go watch the video I posted before this if you're interested in that. And these are all the holdings that I currently own, which is currently 29 different holdings, and this is my breakdown of them and the amount that they pay me. And these are the 29 holdings that I currently own and how much I'm up on them, so you can pause the video anytime if you want to see that. Also, if you want to support me and my channel, M1 Finance did just buff up their referral money from $10 to $20. So right now, if you're watching this and you're interested in M1 Finance and you want to get started investing, you will no longer get $10 for signing up. You will now get $20 for signing up. All you got to do is download the platform using this referral link, which is in the description. And if you download the app using that link and then deposit $100 to the platform, you will get a $20 bill. That's one way to guarantee yourself a 20% return. Just invest $100 in one, get $20 bonus, and then there you go. There's a quick $20, and you'll help support me and my channel. So I have 26 people referred. Go ahead and be the 27th. But let's go ahead and look at where the S&P 500 is and how it's performing. Pretty much all stocks now are at their all-time highs, especially if you're any stock that's related to the tech sector. A lot of consumer, a lot of tech, a lot of higher growth areas like this are at all-time highs, well past their previous highs in February of 2020. It was about 337, 338 back in February of 2020 before the low started to hit and the recession took place, and now we are past $350 a share for the S&P, and not to mention it is another green day as well, up another 0.4%. This dividend yield was about 2.5% in the March lows, and now it's a whopping 1.6%. So now that we know that equities are all-time highs, let's see what bonds are doing. We go to research, we're going to click funds, and I'll be looking at two different things. I'll be looking at corporate bonds, and I'll also be looking at long-term treasuries, governmental bonds. So we're going to click bonds. We're going to click domestic. We're only going to be looking in the United States. And let's go ahead and start with corporate. And let's just go ahead and pick the top fund, the one with the most assets under management. This is what it is sorted by, with $57.8 billion worth of assets under management. And LQD is the ticker symbol. This is only investment grade corporate bonds. So these are the type of companies that are extremely high investment grade, like the one we'll be going over later, Johnson & Johnson. These are at all-time highs, and these are skyrocketing in price, and they don't seem like they're going to stop anytime soon. So I'll be giving my reasons for this and why I think this is either going to stop or to continue. Now let's go ahead and look at governmental bonds. We click bonds, we click domestic again, because we're looking at the United States. Let's hit government, and what we're going to especially be focusing on is long-term bonds. The long-term bonds being the long-term treasuries. Let's look at TLT, one of my favorites. The 5-year performance is up 40+%, and the dividend yield is now only to 1.6%. Now I want to talk about the correlation between bonds and the share prices versus their interest payments. So interest rates currently in 2020 are at rock bottom. I mean, the Fed had just lowered them all the way to zero, and there's really nowhere to go but up. Now, the thing is, Jerome Powell and lots of other forms of government have came out and said that the United States will not go into negative interest rates. Me personally, I think that that is a good move. I don't think the United States should ever go into negative interest rate territory, at least not anytime soon. I think that there will be a lot more negatives to the economy than positives. So, in my opinion, I think that that is a smart move. So what we know is that the interest rates cannot go lower than this. They cannot go below zero. The lowest they can ever go is 0.01, which they have been before. And for years, they stayed at these levels in 2009 during the Great Recession through 2010, 2011, 12, 13, 14, and they didn't begin to get raised all the way until about the beginning of 2016. Now, if we go to these levels right here, you see where we're at right now. You see a pattern here. When recession takes place, just like after the dot-com bubble, things tend to go down, and they usually stay down for a while. And then once we recover, they raise them back to normal to get ahead of inflation. And then once we go back to a deep recession like we did in the Great Recession, these stay down for a while. Now, who knows how long these will stay down? They might stay down for 6 months. They might stay down for 6 years. I'm not going to try to predict that. But what we know is that interest rates will more than likely within the next few years be higher than zero. So what we know is that interest rates will be getting raised. So those of you that don't know, interest rates have an inverse correlation with bond prices. So when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. That is the move, the high move up that these bonds are experiencing, is because bonds are now at sky high prices because the government is buying them back, and anyone that is wanting to invest their money pretty much has nowhere to go but equities, and that's a large reason why we're seeing all-time highs in the equities market in the S&P 500. Another thing about bonds is that once again, with no upside potential and interest rates being at 0% like we mentioned, if you are owning bonds for the interest or the dividends or whatever you want to call it, pretty much the same thing, the interest payments on these bonds are so low. You see these bonds. So this ETF, this long-term treasury ETF, was currently paying a 1.68% yield. But if you go back 2 or 3 years ago, this was paying a 3.5% yield. A lot better than what it is today, about double that. Now, if you go to bonds when it's paying 3.5%, that's a pretty decent yield, and you can compound those quickly. But when you're only getting a 1.68% yield, if you're investing off of dividends like I am, this has a 1.68, while meanwhile the SPY in equity has nearly an identical 1.64%. So if you're investing off of dividends, there's not really much of a reason to own treasuries other than a hedge from a crash because the dividend yield is pretty much the exact same. Treasuries no longer offer great interest payments that a lot of equities could not be able to pay. And in my opinion, I think that is really a disadvantage for these long-term treasuries. And if we look at LQD, once again, corporate bonds, which I think once again have really nothing but downside potential from here, they only offer a 2.9%. And considering they're only 1% higher than that of equities, and equities have the opportunity to grow their dividends rather than these interest payments doing nothing but pretty much going down with the bond prices, I think that both long-term treasuries and corporate bonds do not look as appealing at these levels. And another thing is, this makes it no longer as much as a safe haven. So especially with long-term treasuries, when you see here, TLT, once again, we said there's almost no upside potential. So at its peak, it got up to about $170, $171 a share. So at this levels, what is that, about a 5% move higher than what it is right now currently? If the stock market were to crash, if we were just to have a full-blown panic in the market, these bonds cannot go much higher than 170. 175 maybe, that's really pushing it, but even at that level, it's not even a 10% rise in share price. Pretty much at these levels, all it's really doing is just protecting yourself from inflation, but there's really no upside potential. Not to mention with inflation probably going through the roof with all different types of Fed buybacks going on. So in my opinion, returns in equities will be much likely a greater yield on your return than investing in bonds. Now I know a lot of people like to look at this chart and say, oh my gosh, look how high it is. This is at all-time highs. We're coming out of a recession. It's going to crash a couple months from now. Now, I'm not going to predict whether or not the market will crash, whether it won't. I don't really care either way. But when you're looking at these charts with the bonds compared to stocks, you know that eventually the S&P will always hit higher than it will in the future. One thing I can tell you about the stock price, the only price prediction I'll be making today, is that one day, $350 a share, it'll break past this. It might take a day, it might take 6 months, it might take 12 years. But all I know is stocks will eventually always move higher, and they will always outperform bonds in the long run. So in my opinion, especially since bonds no longer have that safe haven, large interest payment, or basically just any type of upside potential whatsoever, I think that you should be sticking away from bond investing and you should be mostly focusing on stocks. Now, in my opinion, should you invest in the S&P? That depends on your investment risk. Should you be investing in different individual dividend stocks like I am? I think that really depends on what your strategy is and what your goals are. But in my opinion, I think you should be investing in any form of equities that is not overvalued, because I know it's easy to look at some of these stocks, like these tech stocks, like Broadcom, for example, and say, oh my gosh, look, it's at all-time highs. But there's a lot of stocks that are not at all-time highs. For example, my second largest holding, Realty Income, is still well off from its previous 5-year high. You can see that it is currently $62 a share, and this was 80 plus just 6 months ago. So there's still plenty of stocks that you can buy that are still well at a discount with optimal yields, great dividend yields that are double, triple that of long-term treasuries. So in my opinion, guys, equities is the way to go, and you should stay out of long-term treasuries or pretty much corporate bonds in general, in my opinion. Now, let's go ahead and look, now that we've been through federal funds rate and we've been through the basics with bonds, let's go ahead and get into some news. Let's go ahead and look at AT&T and how they might want to sell DirecTV and how this is a benefit for shareholders. Now, in my opinion, AT&T is by far the most in-debt company that I own on this list per capita. This company is very much in debt, and this is not a very financially healthy company, and this is one of those companies that is not going to grow its share price a lot. They are going to have very stagnated growth over the next couple of years, but with AT&T, I'm predicting that they're going to be able to hold up that dividend payment, which is a whopping 7% dividend yield. Now, if they're able to maintain it and continue to raise it at the rates that they are, you are locking in an excellent guaranteed return of at least 7%, not to mention the future share price gains. But that said, this is one of the most indebted companies I have ever owned in my entire life, and selling DirecTV would make them so much financially more healthy and make them in such a better long-term position to capitalize on future markets with telecommunications and 5G, and basically overall would just make them a better company and more optimized to benefit its shareholders. Now with AT&T, it is $29 a share, and it has went nowhere in the last 5 years. It was $32, $33 a share 5 years ago, and like I said, with the S&P at all-time highs, this stock is nearly at lows that haven't been seen in years. Now with DirecTV, they continue to lose millions of users every single month, and they bought the business for $49 billion in 2015. $49 billion. A lot of people are predicting, a lot of these different analysts and a lot of speculators for this merger are talking about if they merge with Dish Network, that they might be able to sell it for $20 billion. Now remember, they bought this for 49 and are looking to hopefully sell it for 20. Less than half of what they bought it for. When you're buying into a dying industry, trying to flip it around, and you're trying to compete with DirecTV with streaming services, I think you're fighting a losing battle. Now that said, I believe that one day DirecTV will go bankrupt. I think that it will probably happen within the next decade. That said, whatever they can get for it, DirecTV, I don't care if it's 1 billion, I don't care if it's 10 billion, 20, whatever the number is, they can sell it for pennies on the dollar, and I will see this as a win. If they do end up selling DirecTV, and especially if they can sell it for a pretty reasonable price, I would even consider bumping AT&T back up to 2% in my portfolio because of that optimal dividend yield. Now that said, I'm still a little bit sketchy about AT&T. Management has not capitalized on things like I thought they would in pretty much any way, shape, or form. So I'm not going to get my hopes up, but if you're wanting to invest in DirecTV, I think now it's probably the time to do it, considering that they might be able to sell DirecTV. And if that deal goes through, I think that it's definitely a lot more reasonable investment, considering that they'll be a lot more capitalized for the future. Now let's go ahead and go to Johnson & Johnson. Johnson & Johnson adds to debt frenzy and borrows $7.5 billion in Momenta deal. Now, Johnson & Johnson is one of the only two companies that has a AAA credit rating. J&J, which makes drugs, consumer goods, and medical devices, stands as the only other major U.S. corporation, aside from Microsoft, still carrying a top AAA credit rating, which NPR's Planet Money explains are akin to the highest possible score in consumer credit. Basically, there are only two large corporations in the planet, in the entire earth, that has the credit rating that Johnson & Johnson does. It's Johnson & Johnson and Microsoft. Now, when these companies want to raise capital for whatever purposes, they are able to raise capital at extremely cheap rates. They just fetched a 40-year bond for a 2.5% yield. Now, when this company is growing revenues 4, 5, 6, 7% every year. Johnson & Johnson right here is 3% of my portfolio. When this company is getting yields on this bond that are 2.5%, but they're growing their business at 4, 5, 6, 7% every year, it doesn't take a genius to figure out that they're picking up these deals at rock bottom prices. And it's not about the Momenta deal. I don't care what type of deal they're doing. I'm not really focused on how good this Momenta deal is going to be. I'm focused on the financing that they were able to get. When you have a company that is financially healthy and growing the way that Johnson & Johnson is, they're able to get deals like this that are incredible. Bond investors flee to Johnson & Johnson because of the incredible credit rating that they have, and they have the type of power to be able to do this type of deal that almost no other company could. So I love this fact that they're able to offer a 40-year bond for only 2.5% interest. Awesome news for Johnson & Johnson. Just one more reason to hold it. And guess what, guys? If there's ever a stock that I've considered bumping up this past month or so in my portfolio, not only for the Momenta deal, but just because of the company in general, I think Johnson & Johnson. I'm still on the fence about considering bumping it up. So we'll see how that goes there. Last but not least, let's go ahead and just get to a little bit of a gag article. Let's go ahead and look at the local hero who doesn't invest so that the market can go up for everyone else. Going against conventional wisdom that when the market is bubble inflated by the Federal Reserve stream of free money, market analysts revealed this week that a local man, Jordan White's decision to not invest is the primary reason for the historic bullish run. Literally the moment I open any position, red candles, confessed White, who was once long Enron, Bear Stearns, and Hertz. I know a company is going to beat earnings, so I buy in and they crush analyst expectations. 30% instant loss anyway. In some years, White has turned to indexes in an attempt to diversify. The result impacted billions. 2008, 2018, early 2020, those were all on me. So I really appreciate this guy staying out of the market. This poor guy going long on Enron, Bear Stearns, Hertz, causing all these market crashes. I think it is not because of any illnesses or any recessions taking place. When you look at the SPY and you see some of the downturns like the one he mentioned, when you see the downturn in 2018, when you see the downturn in 2020, I don't think it was because of any recessionary reasons or any economic factors. I think it was because of this guy. So I really appreciate him staying out of the market so the rest of us can enjoy these sweet, sweet gains. Thank you so much, Mr. White. I appreciate you staying out of the market. But overall, guys, thank you guys so much for watching. I appreciate it if you made it all the way to the end. If you appreciate the transparency and you want to follow along with me on this journey, tracking my annual dividend income, my monthly dividend income, my portfolio value, and my YouTube income, following along with all 29 plus holdings that I'll be having over the next coming months, go ahead and follow along with me. I do plan on disclosing everything in the future, and one of the ways that you can support my channel, like I mentioned in the beginning of the video, $20 now, no longer $10. If you want to sign up, you can sign up for M1 Finance absolutely free, no commissions, no fees whatsoever. You can sign up for M1 Finance, getting $20 just for signing up and depositing $100 to the platform. So if you see 26 here, go ahead and change that number to 27. Thank you guys so much. You made it all the way to the end. Leave a comment down below any questions you might have about bonds or interest rates or really anything in general. I love to hear from you guys. Thank you guys so much, and I'll talk to you guys next time.